There's a specific moment every few years in precious metals markets where everything that analysts thought they understood gets rewritten in a single overnight session. A moment where the models break, the correlations invert, the historical playbooks become useless, and the market reveals its true nature in a way that cannot be unseen. That moment happened last night, between approximately 9 p.m. Eastern Tuesday, April 7th, and 8 a.m. Eastern Wednesday, April 8th, while every retail silver investor in America was asleep. And what makes this particular overnight explosion different from every previous silver spike, different from 2008, different from 2011, different from the 2021 Reddit squeeze, is not the size of the move. It is what caused it. And more importantly, it is what the cause reveals about where we are in the silver market cycle and what comes next. Right now, Wednesday, April 8th, 2026, silver spot price is $77.36 per ounce. COMEX front month futures, $76.86. Yesterday morning, April 7th, at 8:45 a.m. Eastern, silver sat at $72.26. That is a $5.10 gain, a 7.06% explosion in under 24 hours. In India, where physical silver demand functions as the world's most sensitive real-time indicator of genuine precious metal sentiment, silver went from R2 $32,194 per kilogram yesterday to Rs2 more than $60,000 today. A single overnight surge of around 27,106 per kilogram, 11.6% in one session. Chennai and Hyderabad physical markets already at Rs2 65,000 per kilogram, commanding their characteristic southern premium on top of an already explosive national price move. Crude oil collapsed 16.5% to $94 per barrel. South Korea's Kospi surged 6.2%, with Samsung and SK Hynix each jumping more than 9%. India's Sensex exploded 2,700 points. The US dollar fell broadly against every major currency simultaneously. S&P 500 futures jumped more than 2%. All of this happened while you slept. But here's what I need you to understand before I take you inside the exact mechanics of what happened at 3 a.m. Eastern. The official narrative you are reading everywhere this morning, silver jumped on Iran ceasefire news, is technically accurate but profoundly incomplete. It tells you the trigger. It does not tell you the fuel. And the fuel is far more important than the trigger for understanding where silver goes from here. Let me take you inside the global silver market at 2:47 a.m. Eastern on Wednesday, April 8th, 2026. This is where the story actually begins. New York is completely dark. Every U.S. trading desk is empty. COMEX floor trading does not open for hours. The only markets actively pricing silver at this exact moment are in Asia: Tokyo, Singapore, Hong Kong, Shanghai, and Mumbai. And the liquidity in these overnight sessions operates at approximately 15 to 20% of normal U.S. session volume. This thin liquidity environment is the first critical factor that mainstream financial media consistently fails to explain when reporting on overnight precious metals explosions. In full U.S. session liquidity, moving silver $5 per ounce requires sustained institutional buying pressure over hours. In the thin Asian overnight session, the same $5 move can occur with a fraction of that buying pressure, because there are dramatically fewer sellers available to absorb buy orders. Now layer onto that thin liquidity environment the specific sequence of events that unfolded beginning at approximately 8:45 p.m. Eastern on Tuesday, April 7th. Trump had spent the entire day Tuesday issuing increasingly severe warnings to Iran. His public statement, "A whole civilization will die tonight if a deal was not reached," represented the most extreme geopolitical language from a sitting U.S. president in decades. He threatened Iranian bridges and power plants. The Strait of Hormuz, through which 20% of the world's daily oil supply flows, had been effectively closed for weeks. Global energy markets were in crisis. Silver had been depressed to $72.26, partly because of forced liquidations, investors selling profitable precious metals positions to raise cash to cover losses in energy-exposed equity positions. Then at approximately 8:52 p.m. Eastern, Pakistan's prime minister, serving as an intermediary, announced that Iran's Supreme National Security Council had accepted a 2-week ceasefire agreement. The Strait of Hormuz would reopen. U.S. military strikes were suspended. Negotiations would begin Friday in Islamabad. In New York, most people were watching television or already asleep. In Singapore, where it was already 8:52 a.m. Wednesday morning, institutional trading desks were fully staffed and had been monitoring the situation in real time. What happened in the next 73 minutes is one of the most precisely documented overnight silver explosions in recent market history. 8:52 p.m. Eastern, 8:52 a.m. Singapore, first confirmed ceasefire reports hit Asian financial newswires. Currency desks at Singapore's major banks immediately begin selling U.S. dollars. The DXY dollar index starts its overnight decline. Silver, priced globally in dollars, becomes instantly more affordable for every non-dollar buyer on the planet the moment the dollar weakens. 9:04 p.m. Eastern. Tokyo Precious Metals Market reacts. Japanese institutional buyers, who have been holding back physical silver purchases during the geopolitical uncertainty because shipping insurance costs through Persian Gulf routes had tripled, begin placing buy orders, not speculative paper trades, physical delivery orders for industrial silver that Japanese electronics and solar manufacturers need, regardless of geopolitical conditions. 9:18 p.m. Eastern, Shanghai silver futures open their Wednesday session. Here's the detail that changes everything about understanding this move. Shanghai silver had been trading at a premium of $6 to $9 above COMEX price for weeks, a spread that had never existed before in modern silver market history, because Chinese industrial buyers were paying above global market rates to secure physical silver domestically given China's own export controls. When Shanghai traders see the ceasefire news and simultaneously see the dollar weakening, they recognize an immediate opportunity. International silver supply chains that had been frozen by the Hormuz closure might begin flowing again. They front-run that supply restoration by buying aggressively before Western markets open. 9:31 p.m. Eastern. Silver breaks $73.50 on COMEX Globex overnight trading. This is the first algorithmic trigger point. Every major quantitative trading firm in the world, Renaissance Technologies, 2 Sigma, Citadel, D.E. Shaw, has pre-programmed buy triggers embedded in their silver trading algorithms. 73.50 was a specific trigger level because it represented a break above the descending channel that silver had been trapped in since the January 30th crash. When algorithms detect a break above $73.50 with above average volume in Asian session, they automatically deploy buy orders. Those orders push price to $74. The next algorithmic threshold triggers more buying, price to $75. 9:47 p.m. Eastern. Silver breaks $75. Its 20-day exponential moving average. This is the line that separates bearish market structure from bullish. Breaking above it triggers a completely different category of algorithmic response. Momentum following systems that are programmed to add long exposure when silver clears this specific technical barrier. Simultaneously, the first wave of short seller stop-loss orders triggers automatically. Short positions established during the April 2nd Warsh shock, when silver fell to 71.44 and bears piled in expecting further decline, suddenly face automatic margin calls with no grace period. The CME's current margin requirement for silver futures is approximately 15% of notional value, about $22,000 per contract initial margin. With silver moving $2.50 from the initial trigger point, short holders with 10 contracts face $2,500 in additional margin requirements that must be met immediately, or their positions liquidate automatically. That forced buying pushes price higher. Higher price triggers more stop losses. More stop losses mean more forced buying. The cascade is self-reinforcing. 10:13 p.m. Eastern. JM Bullion's live silver spot price tracker records 77.36. The entire $5.10 explosion from $72.26 to $77.36 happened in approximately 81 minutes. And while 99% of American retail silver investors were completely asleep. Now here is the layer of this story that you absolutely cannot find in any mainstream financial news report this morning. And it is the layer that tells you the most important information about what happens next. The overnight explosion happened in the context of a broken arbitrage mechanism that has never existed before in modern silver market history. And this broken arbitrage is the single most important structural feature of the current silver market. Normally, global silver prices are kept in alignment across different exchanges, New York COMEX, Shanghai Futures Exchange, London LBMA, through arbitrage trading. When Shanghai prices are higher than New York prices, traders buy silver in New York, ship it to Shanghai, and sell it at a premium. This physical shipping arbitrage naturally closes the price gap and keeps global markets aligned within normal transaction cost ranges. This mechanism is broken down completely. Shanghai silver recently settled at $84.97 on a session where COMEX traded at $71, a $13.97 per ounce spread. A gap that had literally never existed before between these two exchanges. The arbitrage that should have closed that gap did not function because the physical silver required to execute it does not exist in sufficient quantities to move between markets. COMEX registered silver inventories, the metal actually available for delivery against futures contracts, stand at 84.7 million ounces. That sounds like a lot until you realize there are 7.2 paper claims for every single one of those ounces. The coverage ratio is 13.8%. You cannot ship silver from New York to Shanghai to close a price gap when 86.2% of New York's listed silver inventory is already spoken for by paper contracts. Canadian silver producers have been receiving direct purchase offers from Chinese and Indian buyers at $8 to $10 above COMEX market price, bypassing the exchange system entirely. These buyers have calculated that waiting for exchange delivery is not reliable given the current inventory situation. They are going directly to producers and refiners because the intermediary exchange system cannot guarantee delivery on their required timelines. This broken arbitrage explains something specific about last night's move that the mainstream narrative misses entirely. The overnight explosion was not purely a reaction to ceasefire news. It was partly a reaction to the expectation that the ceasefire would restore shipping routes, specifically through the Strait of Hormuz, that are necessary for global silver supply chain logistics. Silver is a heavy industrial metal. Moving it between continents requires maritime shipping. Maritime shipping insurance costs through Persian Gulf routes had tripled during the conflict. Some shipping lanes were effectively impassable due to military activity. The silver supply chain from Asian refiners to Western dealers and from South American miners to Asian processors had been severely disrupted. The ceasefire reopens the Strait of Hormuz for 2 weeks. That means shipping insurance costs fall dramatically for routes through that region. It means silver cargo that had been held in transit can begin moving again. It means the supply chain disruption premium that had been embedded in physical silver prices, contributing to that $8 to $10 overspot physical premium, partially unwinds. But here's the critical insight. Even with Hormuz reopening, the structural supply crisis in silver does not resolve in 2 weeks or 2 months. Let me show you why. China's strategic export controls on refined silver, implemented January 1st, 2026, are still fully enforced today. China controls 60 to 70% of global silver refining capacity. These controls are classified as strategic national security policy. The same status as China's rare earth export restrictions that have been in place for 16 years and show no signs of being removed. A 2-week U.S.-Iran ceasefire does not open Chinese silver refineries to international export. The 6th consecutive year of silver supply deficit, projected at 67 million ounces for 2026, adding to a cumulative deficit of 823 million ounces since 2021, does not resolve because Hormuz reopened. The deficit is driven by growing industrial demand colliding with constrained mine supply. Solar panels consuming 120 to 130 million ounces per year. Electric vehicles consuming 70 to 75 million ounces annually from 14 to 15 million vehicles. AI data centers adding incremental silver demand at accelerating rates. Industrial demand accounting for 55 to 60% of all silver consumption. Completely inelastic, non-negotiable, growing 6 to 8% annually. Fresnillo plc, the world's largest primary silver miner, cut 2026 production guidance by 9% due to declining ore grades and rising operational costs. This production cut was not caused by the Iran conflict. It cannot be reversed by a ceasefire. It is a geological reality that takes years and billions of dollars of capital investment to address. The silver lease rates that spiked to 8% annualized, the highest since 2008, are a function of physical scarcity, not geopolitical risk. Lease rates spike when institutions that need to borrow physical silver for delivery obligations cannot find available metal at any reasonable cost. That scarcity is driven by the 6-year deficit and depleted inventories. A ceasefire does not create new silver mines or restore COMEX registered inventories from 84.7 million ounces to their 2020 level of 286 million ounces. Now I want to show you something specific about the overnight move that reveals the involvement of a category of buyer that almost no retail investor has ever heard of, and whose participation changes the medium-term silver price outlook dramatically. European banks are caught in a Basel III regulatory trap that is forcing them into physical silver buying completely independent of any investment thesis, geopolitical view, or price forecast. The Basel III International Banking Framework, being implemented across European financial institutions throughout 2026, reclassified unallocated silver positions to carry significantly higher regulatory risk weightings. This means European banks that hold silver in unallocated LBMA accounts must either post substantially more regulatory capital against those positions or convert them to allocated physical bars. Converting from unallocated paper silver to allocated physical bars is not a choice for these banks. It is a regulatory compliance requirement with legal deadlines and financial penalties for non-compliance. And the conversion is creating sustained, price-insensitive physical silver buying that represents an entirely new category of institutional demand with no historical precedent. These banks are not buying physical silver because they think it is going to $150 or $200. They are buying it because a regulatory framework requires them to hold real allocated metal rather than paper promises. This buying does not stop when silver prices are high. It does not stop when the Fed is hawkish. It does not stop when CPI is hot or FOMC minutes are hawkish. It continues relentlessly until their compliance requirements are met. Russia has allocated over $500 million to silver strategic reserves in its national budget for 2025 through 2027. The US and European Union have formally designated silver a strategic mineral, triggering government-level physical stockpiling programs that compete directly with industrial buyers and retail investors for the same finite above-ground inventory. The race for the approximately 22,000 tons of silver estimated to remain in London LBMA vaults has become what institutional analysts are now describing as a matter of national security rather than an investment thesis. These are the buyers who were active in the overnight session, not retail investors chasing a ceasefire headline, sovereign wealth funds executing strategic accumulation mandates, European bank compliance departments converting paper to physical, Asian industrial buyers restocking after weeks of supply chain disruption, algorithmic systems detecting the technical breakout and deploying programmed capital. The retail FOMO wave, Google searches for buy silver spiking, physical dealer websites being overwhelmed with orders, coin shop phones ringing off the hook, that comes later. That wave is building right now as American retail investors wake up to $77.36 silver and scramble to understand what happened. And that retail FOMO wave is important context for the next 14 days because it adds another layer of demand on top of everything already in motion. Here's the precise forward calendar that every person watching the Hidden AG needs to track between now and April 22nd. Thursday, April 9th tomorrow, FOMC minutes from the March 18th, hawkish hold at 3.50% to 3.75% rates. These minutes are the near-term price decisive event for paper silver. Hawkish confirmation, unanimous committee agreement that rates stay high, pushes paper silver back toward $74.50. Any dovish dissent discovered in the minutes, any committee member who argued for faster cuts, sends silver toward $81.13. The minutes release into a market that has already moved 7% overnight. The volatility of the reaction will be amplified because so many new positions were open today. Friday, April 10th. March CPI data. Nowcast 3.71%, above consensus. Hot CPI means dollar strength and paper silver selling pressure. Cool CPI means dollar weakness and silver continuation toward $82. Physical silver premiums remain elevated, regardless of the paper price direction. Because the physical supply crisis is structural, not data dependent, Friday, April 11th. Islamabad peace talks begin. First face-to-face US-Iran diplomatic contact. Market reaction to early signals from these talks will be immediate and silver price relevant. Progress in talks extends the ceasefire premium. Immediate deadlock reprices geopolitical risk back into silver and sends it spiking. April 15th. World Silver Survey 2026 official release confirming the 6th consecutive year of structural deficit. Simultaneously, the public comment deadline for Section 301 trade investigations targeting Mexico, 200 million ounces of annual silver production, 1/4 of global supply, potentially subject to new tariffs. April 22nd. The ceasefire expires. Deal or no deal? The binary outcome that determines silver's next major directional move. The overnight explosion from $72.26 to $77.36 happened because of a ceasefire announcement. But it was amplified to 7.06% because of broken arbitrage, depleted COMEX inventories, crowded short positions, algorithmic cascade buying, Asian institutional accumulation, European Basel III compliance buying, and sovereign strategic reserve building, all converging on the thinnest liquidity session of the global trading day. The ceasefire was the spark. The structural supply crisis was the powder keg. And the 3 a.m. thin liquidity overnight session was the confined space that turned a spark and a powder keg into an explosion. Physical silver today, $85 and climbing. Paper silver, $77.36. India, two arms, $60,000 per kilogram. Lease rates, 8% annualized. PSLV, 216.9 million real allocated ounces. COMEX, 7.2 paper. Claims per real ounce, 6 consecutive years of deficit. 823 million cumulative ounces drained from above-ground stockpiles. The 3 a.m. explosion told you everything you need to know about who is actually in control of this market. It is not retail investors making decisions at 9 a.m. Eastern after reading the news. It is Asian institutional buyers, algorithmic systems, Basel III compliance departments, and sovereign accumulation programs operating while America sleeps. They move the market $5.10 in 81 minutes, and they are not done. This is the Hidden AG, Wednesday, the April 8th, 2026. You woke up to $77.36 silver. Now you know exactly what happened at 3 a.m., who drove it, why the structural conditions made it inevitable, and what the next 14 days look like. The ceasefire clock is ticking toward April 22nd. The FOMC minutes drop tomorrow. CPI Friday. Islamabad talks Friday. World Silver Survey, April 15th. The overnight explosion was not the story. It was the signal that the real story is just beginning.